Hi everyone, my name is Putrina Zainab binti Makrameh. Today our group will be presenting the case study about IPO of Hilda Global Venture Holding. Okay, about the introduction, Afiq Firash received a birthday gift from his mother, which is a saving account book from Tabung Haji showing a balance of 25,000 ringgit. His mother has agreed to let him pursue a minor degree in Islamic Financial Engineering in UK. So the cost is about 40,000 ringgit. How would the money grow? Rauf, his cousin, suggests that Afiq Firash to buy IPO, and Rauf told that he had submitted a subscription for 10,000 units under his own account and 5,000 more in his wife. Next is about two types of palm oil. The first one is palm oil and the second one is palm kernel oil. Next is about based on Rauf's email. The graph show about the changes of price of CPO and 2007 until 2012 show that the lowest price and the price down and increased back at September 2011. Next is about factors of changes in CPO and CPKO price. The first one is replanting pattern, weather condition as well as pest and crop disease. The second is the market force and economic condition, and lastly availability of other types of substitute vegetable oils. Next is about the major palm oil producer and exporter, which is Nigeria, Thailand, Colombia, Indonesia and also Malaysia. Next, in 2011, Malaysia has export more than 39 million tons, and in 2010, Malaysia export 16 million tons, and in 2011, Malaysia is export 12,000 million tons of palm oil. Next, about the matured planted area of palm oil in Malaysia, and FGVH contribute most compared to the other companies. Next is about background of FGVH. FGVH was incorporated in Malaysia in 19 December 2007, and FGVH served as the commercial branch of Hilda for overseas investment, palm oil and other agriculture business. There are three main types of business. The first one is plantation, downstream and sugar.
First question, the prospect of the market and respective sector in the short run and long run. From the independent market research report by Frost and Sullivan, the future outlook of the oil palm industry in terms of oil palm cultivation and moulding can be estimated based on historical correlation between supply, demand and prices, as well as the impact of the future driver in the industry. Global supply demand of the palm oil show a stable upward growth trend. Frost and Sullivan forecast for the supply CPO to continue growth on a stable upward trend, and also for demand forecast has increased. In year 2012, 62.7 million tons of supply will be increased to 74 million tons in 2015, with a compound annual growth rate of 5.9%. For the demand, 2012, the oil palm will be 52.7 million tons, will be increased to 60,000.7 million tons in 2015, with a compound annual growth rate of 4.8%. The annual average local delivered prices for CPO in Malaysia has increased. Frost and Sullivan has used regression analysis on supply and demand adjusted relative to price in 2011 to estimate the forecast price for CPO. In 2012, the price per million ton is 3,323, has reduced to 2,932 per million ton in 2014, and the forecast will be even drop lower to 2,867 per million ton in 2015. The government support has lowered the CPO prices compared to crude oil and others. Edible oil process oil palm industry in Malaysia expected growth continuously. This is the chart graph showing the compound annual growth rate for supply, the historical forecast trend of CPO supply. This is the forecast of supply demand annual average local delivered prices for CPO. For global edible oils and fats market, Frost and Surveillance expect growth consumption of edible oils and fat to record healthy growth over the next 4 years. Global consumption will increase by 4.2% and demand expected to remain concentrated in Asia. Increasing demand from China and India, global population growth and increase in global use of biodiesel. Because of lower pricing and higher variability relative to edible oils and fats, supported by increasing planted area, strong government backing in Malaysia, as well as continuous research development on genetics and new applications. For global edible oils and fat market, there is change in export taxes. Malaysia announces a 3.6 million ton duty-free export quota for CPO 2012 and anticipate an increase in export. Indonesia export tax reduction on refined palm oil products. Global oleochemical market, Frost and Surveillance projects the consumption of the oleochemical industry to witness strong growth over the next 4 years. In 2012 is 18.5 million tons. The forecast for 2015 is 21 million tons and the compound annual growth rate of 4.3%. The global market for oleochemical is expected to be strongly driven by the wide range of application of oleochemical along the increasing demand from emerging markets. Sugar refining industry, Frost and Surveillance estimated the consumption of refined sugar in Malaysia growth at a healthy pace. At 2011 is 1.5 million tons, will be estimated in 2015 will be 1.8 million tons of the compound annual growth rate of 2.9%. This is supported by increasing level of domestic sugar consumption, growth in food and beverage manufacturing and process industry, and increase in household consumer. This is the chart showing the projected refined sugar production and consumption. Rubber industry, based on the historical trend, global consumption of natural rubber exhibited stable upward growth. albeit dips in 2011 and 2009 due to economic slowdown after the September 11 attack in 2011 in US and the global economic slowdown in 2008-2009, which caused a disruption in rubber supply. Frost and Surveillance forecast the consumption of the natural rubber to increase from estimated 11.5 million tons in 2012 will be forecast at 12.9 million tons in 2015 with a compound annual growth rate of 3.9%.
We calculate for the expected return of the share in the general and the recent time. In order to get the expected return, we're using the CAPM formula, which using the risk-free rate plus the market risk premium times beta. The market risk premium is calculated using the market rate of return minus risk-free rate. In order to get the CAPM, we have using the data for the 1 year, 3 years average, and 5 years average. The 1 year, if we're using the 1 year data, we will get the expected rate of return of 3.223%. for the 3 years average CAGR we get a 10% and 5 years average CAGR we get a 2.75%. In order to get the expected return, we are using the beta for the company, which is the Sam Gabi during year 2012. The beta of the Sam Gabi during 2012 is 0.9. Then we will get for the growth rate of the company, of the market. In order to get the data, we have to use the average treasury bill to get the risk period and the average the growth of the KLCI to get the growth rate. Using 1 year's data, we get the risk period of 2.98 and the growth rate of 3.25. If using the 3 years average data, we will get the risk period of 2.634 and the market growth rate of 10.82. If we're using the 5 years average data, we will get the risk period of 2.878 and the market growth rate of 3.085. Next, we will move to the intrinsic value of the company. We will using the Golden Growth model to get the intrinsic value of the company. The intrinsic value is calculated using the expected dividend minus by the expected rate of return minus by the growth rate. So in the intrinsic value, we are using the current year is 2012 and the 2013 is the expected return year. So according to the ECM Libra research in the 4th of June 2012, the earning per share is using to calculate the growth of the earning per share is used to be the indicator of the growth rate. So if we using the growth rate, if we using the 1 year's average data, we will get the intrinsic value of 55.616 cents. And if you're using the 3 years average data, we will get the intrinsic value of 43.665 cents. And if you're using the 5 years average data, we will get the 56.407 cents intrinsic value. This is the data that we can get from the ECM Libra research.
Hello everyone, I will present for the question number 4, that is the expert opinions about the IPO of FGVH. Okay. Based on TS Securities research, FGVH will be making its debut on the Bursa Malaysia and on 28 June 2012. It is the largest domestic IPO of the year. The IPO involved offering of up to 2.2 billion shares, comprising 1.2 billion of full for sale shares and public issue of 980 million new shares, and an indicate retail price of RM4.55 per share. The retail and institutional offering will close on June 12 and June 13 respectively. The IPO SSM will raise a total of 10 billion ringgit, out of which approximately 4.5 billion will accrue to FGVH. For their research on earning outlook and valuation, their target price is at 5 ringgit and 50 cents. Okay, the value of FGVH at 5 ringgit 50 cents based on estimated core EPS, which is at 42.3 cents in year 2012. The target price earning ratio of 30 times translate into approximately 70% discount to the market cap weighted average price earning ratio of the 3 largest Malaysian plantation companies such as IOI Corp, KLK and Sam Gabi. Okay. The target price translate into 21% potential capital gain, and therefore the initiate coverage on FGVH with a buy recommendation. Okay. Next, based on ECM Libra's investment research, okay, with the fund raised from the IPO, FGV plans to set aside 84.0 million ringgit for the purpose of acquisition of oils and fats, manufacturing and logistics, business, and 2.19 billion ringgit for the acquisition of plantation assets. They expect FGBH to venture into countries such as Indonesia and Africa to expand their plantation assets, as these countries are able to provide soil and climate conditions similar of those in Malaysia. On the downstream front, they expect FGB to expand into fast-growing economies such as China and India. Okay. For the lastly, for valuation and recommendation, they initiate coverage of on FGBH with a buy recommendation. They value FGBH at 5 ringgit and 65 cents based on 60 times PE PAC against year 12 EPS of 35.3 cents. Their PE is based on the average of II Corps and KL Kepong's calendarized PE. Their target price implies for year 2012 at price of book of 3.4 times and dividend yield of 3.1%.
Ask question about number 5. So what offered others investment alternative that are enable for him to grow the money? What a return on those investment? So the first choice is amanah saham, which is a unit trust. So we can see on table about performance. So the return estimation around 2% per year at 2011. So the second, which is a fixed deposit, we can see on table all bank in Malaysia average rate about 3.0% above, so it can be risk very low. The third, about share, we suggest KLCI share. It grow rate in July 2011 to June 2012. The price return is 3.25%. The risk is moderate. The fourth, about bond, you can see in table coupon rate is 3% above from 2011 for 2014. Okay, we can see in table market report on May 2020 2011 about performance bond. So we can choose REIT, include real estate investment trust. Distribution from trust, the last choice is invest in our business, but the rest is maybe can be higher because he do not have experience in business. The last question is based on result of analysis, give the pros and cons should Firash declare to invest in IPO. The pros, high prospect of return based on trust and solid prospect is supported by research house. Cons, risk fluctuation of expected return, low intrinsic value, estimate true value of stock lower than IPO price. So we can talk about recommendation. Afiq Firash should invest in IPO based on his risk tolerance level. If Afiq Firash in the risk taker so he can buy IPO. If not, he better to find another alternative. We can see in question 5, we suggest Afiq Firash not to invest because the lower intrinsic value of FGPH IPO based on our calculation.